funsupermart.com.
In this webcast, I will share my views on the potential risks and rewards associated with investing in China. The Chinese equity market has delivered 2 consecutive years of disappointing performance during a time in which its economy grew at 10.4% and 9.2%. This has put the market in a position with extremely attractive valuations, while corporate earnings growth has remained robust. Cheap valuations, along with strong corporate fundamentals, has given the market the highest upside potential among the markets in our coverage, keeping a 3-year investment horizon in mind. This has subsequently led us to change our most favored equity market from Taiwan to China this year. But of course, there are also risks associated with investing in China, which I will also outline shortly. First, let's take a look at the reasons that lead us to favor the China equity market. As I just mentioned, valuations have reached extremely attractive levels. If we look at the Hang Seng Mainland 100 index, we can see that valuations have dropped below the historical mean since the end of 2010. Since then, it has even pierced through the 11 times level, which is a level 1 standard deviation below the historical mean. This is significant because under conditions of normality, valuations should remain within the bounds of 1 standard deviation from the mean 68% of the time, which is within the 2 red dotted lines. In addition, if we look at the valuations trend in the past 10 years, we can see that the trailing PE has only dropped below the 11 times level 3 times. And almost immediately after these 3 points, the market experienced a strong rebound. Now valuations have dipped below the 11 times level for the 4th time, suggesting that a buying opportunity has come about once again. The second reason that leads us to favor the China equity market is related to its economic growth. Although external demand may continue to weaken, we believe that China will continue to remain as a backbone supporting global economic growth. If we look at even the most pessimistic economic forecast, the economy is still expected to deliver a 7.9% GDP growth for 2012. But more convincingly, this year will be a fundamental year for China to implement its 12th five-year plan as it enters the 2nd year in dealing with the addressed concerns. The 2nd year is usually the year in which plans are implemented most effectively, which means that we will likely see large progress made towards becoming a consumption-driven economy this year. This will help address the problem of unsustainability associated with the nation's economic growth model, as it has been too reliant on investments and exports previously. On the other hand, we believe that monetary policy will act as a market catalyst. Referring back to my point of attractive valuations, some investors may doubt the persuasion of this point because valuations have been below the historical mean for almost a year and a half now. So why is now the right time to invest? We think equity markets were depressed in the past 2 years due to the expectation of monetary tightening, or the fear that policy will become too tight. But now that inflation has become less of a concern, we've already started seeing signs that the central bank is ready to move towards accommodated monetary policy. For example, in the start of December last year, the central bank cut reserve requirement ratios. On the other hand, it also conducted other measures in order to ease liquidity, such as injecting funds into banks via reverse repo operations. So to sum up, there are 3 broad reasons that lead us to favor the China equity market. This includes attractive valuations, sustainable economic growth, and a shift towards accommodative policy, including both fiscal and monetary policies. At this point, we should also talk about the risks associated with the Chinese economy, as these risks help to explain the massive sell-off in Chinese equities in the past year. I think the most significant risk to the economy is related to the property market. A surge in lending activity caused by the 4 trillion renminbi stimulus package in 2008 led to overinvestments, especially in real estate. And this led to a soar in property prices. Since then, the government has implemented several measures in order to curb property prices, but the fear now is that a sudden slump in property prices will lead to a spike in loan defaults. And an increase in loan defaults leads us to the second risk, which is a rise in non-performing loans. In order to understand these 2 risks, we conducted a stress test to put the situation in perspective. Before we look at the stress test, we can first take a look at the bank's NPL situation over the past couple of years. Here we can see that not only has the NPL to total debt ratio been steadily declining, but the loan loss provision have also increased to over 200%. This implies that for every $1 of potential loss from NPLs, the bank has put aside reserves of over $2 to compensate for the possible but not definite loss. Our stress test indicates that in the event that banks' NPL ratios increase 2 or 4%, they would not be under any pressure of meeting capital ratios requirements. On the other hand, if the NPL ratios increase to 6%, they would be on the fence of meeting the 8% Tier 1 capital ratio required by the Basel III standards. This should not make investors nervous, however, because we haven't accounted for the room for banks to raise capital in order to boost their ratios. Whether or not they can successfully raise capital will highly depend on the liquidity in the markets. As mentioned earlier, we do think that the liquidity environment is set to improve, therefore we would not be over-concerned with the NPL issues. Apart from the NPLs issue, there's also the concern that the economy will slow down. We think that weaker economic growth is inevitable, but we have factored this in through conservative corporate earnings growth estimates. We forecast that the HSML 100 index's earnings growth will be at 8.7% and 17.9% for 2012 and 2013 respectively. This is slightly more conservative than the market estimates. In conclusion, we currently have a 5-star or very attractive rating on the Chinese equity market. Reasons include cheap market valuation and strong corporate earnings growth potential. We also believe that given a shift in monetary policy stance, the market could be supported with a strong upwards momentum in the coming years.